Hi, I'm Kevin Castaneda, and this is Kevin's Mindset, and today we're going to be talking about why it's important to invest differently depending on your age. Now, I am currently 16 years old, and that's pretty young for the investing space, but I currently invest differently than if I would if I was like 40 or whether I was 30 or 50 or 60 or whatever. But the reason I invest the way I do, which is usually growth and a little bit of dividends, is because I believe that given the fact that I'm younger, it makes more sense for me to invest in companies that I love long term and see huge growth opportunities in. And this does not defeat the fact that, okay, you should go speculate and buy options on companies you don't even know about. That's not what I'm about. But I do look at companies that I see growth in. I like mostly profitable companies, but they don't always have to be profitable companies. If they're non-profitable companies, but I see revenue increasing like crazy, I see their brand growing, I see their direction as a company, I'm willing to take that risk and invest in that company. Now, it's really important to see your objectives and see your goals. If you have a large sum of capital and you are kind of just trying to preserve that while growing it a little bit, you might want to head in the direction, where you invest in companies that are kind of really established companies that pay you out dividends and that are kind of slower growers. That might be a safer alternative. However, given your age, it kind of allows you to kind of see where you are on a spectrum. Now, are you really young and willing to take a little more risk with higher returns, capable of higher returns in your portfolio? Or are you a bit older? You have that capital saved up. You want to just kind of preserve your portfolio and grow it a little bit over time. What are you looking for and why are you doing that? And how comfortable are you depending on what companies you hold? Now, I hold companies like Enphase, and that's a newer company, but it's growing a lot. Revenues are growing, bottom line's growing. I see the company doing very well. I then again own another company like Affirm, which is the biggest position in my portfolio at the moment. I have about 23%, of my portfolio in Affirm. And I think Affirm's a great company. I see Affirm doing great over the long term. I see consumer trends heading towards spending using something like Affirm where you have certain installments, you could do it over a longer period of time, shorter period of time, and you buy things over time instead of putting everything down now. It's a business model that's been around forever. We see things like credit cards, and credit cards have been used for a long time. And I see this business model being just like that, except a newer and more kind of refurbished version of it that seems more appealing for consumers. So I see companies like this that are growing, that have a nice bottom line maybe, and these companies, if I see their vision and if I'm completely like in line with what they want to do, then yeah, I invest in those companies. And I think it's really important to find the companies that you love and find companies that you're comfortable being in. Now, you might be more comfortable holding a stock like AT&T, which I also own, and AT&T pays you out a dividend. It's about, I think, 8% give or take right now. I don't know. I bought it when it was at like a 9% yield because it was falling like crazy, and I'm doing pretty well at it. But you want to find companies like that have a lot of opportunity in them as well. So I say it makes more sense to take that little risk and kind of look for more growth if you're younger, because you have the time to, like, let's say it all goes bad. Let's say you're learning about this company, you think it's going to be great and it doesn't hit. It's all right. You have a long time to recuperate from that loss. But let's say you're older. Let's say you're not willing to make that risk. Maybe you do go for those companies that are a bit safer, those companies that maybe aren't completely changing the world, but maybe they're safer, maybe even slightly like riskier companies, which in my opinion at this point are not crazy risky companies like Apple, Amazon, Google. They're kind of blue chip tech companies now. They're still growing. They have great bottom lines. Companies like that are also really safe and sound investments. Maybe you won't see the same growth you'd get if you bought a kind of newer up or coming company, but I think it's really important to place yourself in a spectrum and say, okay, what are you looking for and how much risk are you willing to take on? How much work are you really willing to put in order to learn about these companies? Or do you just want to buy the S&P and like hold the S&P and watch it go up slowly over time? I think it's really important that each individual investor looks at this and decides what they want for themselves and not to just follow whatever trends you see, whether it's on TikTok, YouTube, or whatever. It's important for you to look at companies yourself, have conviction in those companies yourself, because you know what happens when the market falls and you see your stocks going down 10, 20, 30% or whatever. If you see your companies going down so much and you feel like you need to sell because you don't know what you bought and you bought some random company that you knew nothing about, And that's the problem with the market. A lot of people buy into companies that they don't know about, and then they end up selling when it's red. That happened to me. Trust me, I'm no exception. I bought into companies that I didn't understand because I saw videos, I saw TikTok, I saw these things when I was first learning, and I would buy them because people said they were going to go up. And I had no idea what the company did. I had no idea what their future was. And if I did, it was from a short TikTok that explained simply like, oh, they're an EV company, like Nikola or something. And I think it's really important to focus on the fact that if you like a company, you have to know why, and you should be able to explain it really quick. Like Peter Lynch, a very famous investor, says, if you can't explain your business in less than like 30 seconds to someone, then you probably shouldn't be in that business. And now that's obviously not financial advice, but it's important for you to know your company that you're investing in, and it's important for you to know everything that's in your portfolio. So this video is just kind of to say, like, know your companies and know your objectives. If you don't know those things, then you're probably not going to do too great in investing. So make sure you know those things, and you're setting yourself up for a pretty great investing journey. So let me know what you think in the comment section down below. I'd love to hear it. Go ahead and smash that like button if you did enjoy this video, and subscribe if you do want to watch more of my content in the future. I'll see you in the next one. This was Kevin's Mindset. Thank you so much for watching, you guys. I'll see you.